Okay, let's move over now to see what we are saying. It's actually what is needed. I want you to look at these highlighted areas, like on the reflections. They are dealing with the case of Steinhoff. Steinhoff, it's a very complicated group with a lot of risk involved and complex transactions that were there. So the auditor should know that they are dealing with at least 30 different tax legislations or frameworks applicable to different countries. So if you are actually an auditor of Steinhoff, you know Steinhoff anyway. It's not new to all the audit students. So you needed to have extensive knowledge of many issues pertaining to Steinhoff. They had 12,000 different outlets with different offerings, and the structure was complex in different countries. So you need to know the legislation applicable to those countries and also accounting frameworks allowed in those countries. So that is Steinhoff that was mentioned there. We've dealt with the scope. So now we are dealing with pre-engagement activities. So we have actually dealt with that. The auditor, prior to accepting the assignment, should be able to determine whether they're eligible to accept to act as an auditor as per the APA, which is Audit Profession Act, and also look at the relevant statutory requirements surrounding appointment of the auditor, if they have actually been complied with. In case of the Companies Act, the requirement is that the shareholders should be appointing the auditor. They must see that in the AGM, the auditor was appointed in the AGM. The directors can actually appoint the auditor and get ratification done at the AGM or at the general meeting. So you don't accept an appointment when that has not been followed properly. So if we zoom straight, there is a standard, quality standard, which is an internal standard, which is ISQ1, which deals with the appointment as well. And you have to look at that standard pre-engagement before you accept an appointment. But the standard is actually applicable internally in the company or the audit firm. Then there are some special requirements by ISA 210. You are prohibited from accepting an appointment or engagement where management impose a limitation on the scope of the auditor's work, such that the auditor believes they are unable to express an opinion on the annual financial statement, and that the precondition for an audit is set out on paragraph 6B of the same standard are not present. So we will deal with the case. There is a case here of Connex. We look at Connex and look at the letter written by the director, Usabelo, financial director Usabelo, to the audit partner, requesting them to make their presentation so that they take over as auditor. So that was 10 marks, and that's where you got it wrong. So your answer is here. Management should not impose limitation of scope of the audit work, so that they cannot be able to express their own opinion on the fair presentation of the financial statements. And there is a precondition that should be present. If that precondition is not present, then the auditor should not accept that particular appointment. Let us look at what is that precondition for an audit. So firstly, the financial reporting framework to be applied in the preparation of financial statements must be acceptable. Without an acceptable framework, management does not have an appropriate basis for the preparation of the financial statements, nor does the auditor have suitable criteria for auditing of financial statements. So you've dealt with your audits postulates. Your audit postulates are actually assumptions on the audit. There is a one postulate that says or states application of IFRS renders our financial statements to be fairly presented. In this particular case, if there is no acceptable reporting framework, you don't have to accept that particular assignment. Secondly, management must agree and acknowledge their own responsibilities. So among any other thing, the first responsibility, not in any order, is that the preparation of financial statements in accordance with the relevant financial reporting framework is one of their responsibilities. The second one, implementation of internal control as they deem necessary to enable them to prepare financial statements that are free from material misstatements. Understand the objective of financial of systems of financial controls, that is to prevent, correct, and detect material misstatements. Then the last one is that they will provide the auditor with access to all information relevant to the preparation of financial statements. Any additional information that the auditor may deem necessary for the purpose of his engagement. So an auditor should have. Yes, sir.
Understand. I have a test. Economics. What's up?
Hello?
Maybe we can try tomorrow. So how much ask you that?
Who can assist with telling him?
Check our sector to pada, eh?
Chabizo. Okay, I've muted him. All right, let us continue to see if we get anyone. Although it disturbed us a little bit. So I won't go through the acceptable financial reporting framework. Suffice to say, application of IFRS, the big ones, IFRS for SMEs in the public sector, CRAP is acceptable in terms of the Companies Act and in the South African perspective, right? Those are the three that we know of. Two belongs to private sector and one belongs to public sector, and that one is GRAP, generally require recognized accounting practice. So if the auditor believes that is not prohibited from conducting an audit in terms of IS 210, then we can be looking now guided by ISQC 1 and ISA 210. That is quality control for an audit of financial statements. The difference is here is that ISQC 1 applies to individual firms. It's an internal arrangement within the firm for established to comply with ISA 220, which is, if you don't comply with ISA 220, you can be in breach of professional conduct, and your professional body will take action against you. So to comply with that, so ISQC 1 was developed, which is quality standard applicable to firms. And there is a topic dealing with acceptance or retention of audit clients there, and that's where the pre-engagement activities find place. So the difference between the two is actually mentioned here, which will not go through because I've just mentioned that. Then this is planning. We won't be dealing with planning. I think we need to look at what constitutes engagement letter, and engagement terms. So there is your engagement letter. The importance of engagement letter, as alluded to, is that when there is a civil proceedings against the auditor, then they will serve as a defense to say, actually, we agreed with the client that will be doing A, B, C, and D. So you've got your terms that I will be performing an audit, and my audit will be on a test basis. So I want to be taking the whole population to be on a test basis, and I'll be reporting on the fair presentation of the information in the financial statements. And that's all I'm going to be doing. And I'll be doing my audit in accordance with ESAs. So that's what I'll be doing when I'm registered audit. And my fees are so much, and I hope the audit will be finalized on such and such a date. And I'll also comply with the Code of Professional Conduct as issued by International Code of Professional Conduct Board, or by IRPA or by SAICA. Then you let your client sign, and you also mention how your fees are to be charged. And that's your engagement letter with the client, and it serves as a contract between the two that is binding, and it eliminates any other confusion. So the content of this letter will prescribe the following: the objectives and scope of the audit of the financial statements. When are we auditing and what are we auditing? The responsibility of the auditor. It's always an expression of an audit opinion on the fair presentation of financial statements. The responsibility of management. So management is responsible for issues pertaining to the preparation of financial statements that complies with financial reporting requirements for a particular country and for a particular form of business. In our case, it would be a company in South Africa, Companies Act, and in accordance with the JS listing requirement, it's a listed company. Then your internal controls, are there any internal controls effective, responsible for detection, prevention, and correction of material misstatements as and when they occur? The identification of the applicable financial reporting framework, I've just alluded to that, and the expected form and content of any report to be issued by the auditor. This will be a statutory report guided by ESA 700, if I'm not mistaken. So straightforward, let them sign, and also included in the engagement letter, the inherent limitation of an auditor, of an audit, because it's done on a test basis. We're not using the full population. That should be mentioned. That's an engagement letter. Check your engagement letter in ISA 210, but I think that will be enough for you to understand the engagement letter. In this particular instance, actually we have agreed with the client, and it has been reduced to writing, and both parties have signed. So there is a meeting of mind as to what the audit pertains and what the responsibilities of the auditor are and what the responsibilities of management are. And also in this particular case, in terms of section 1090 of the Companies Act, the auditor is prohibited from performing accounting work on for the company that they audit or the entity that they audit. So you must bear in mind that results in self-review. Right. So in the book, they say you must take a few minutes to read the example of an audit engagement data contained in paragraph 1 to ESA 210. Note how it complies with the 5 aspects mentioned above. Easy. Please go through quickly on engagement letter to see how it looks like, because you might find a question in your next assessment dealing with engagement letter or agree in terms of engagement. Any question so far? Because we come to the end of the first part, which is engagement activities and issues that are dealt with under engagement activities category or step. Is there any question? Okay, I've alluded to the fact that you don't get direct questions if you are being assessed online, because you have access to all your books and no one is actually invigilating you. There is a question, I don't know whether I still have it, that was posed to you on the assessment 2 with regards to Connex. So because I've just taught you this, it will be easier for you to answer. It was a 10 marks question. I've just read issues pertaining to pre-engagement activities and leave all those that pertains to revenue and receipt cycle. So I read the scenario in the assessment 2. Connex Pty Ltd, also referred to as Connex, is an online advertising company that was started by 2 siblings, Ulangenihle no Minenhle, both Ndebeles. The company's year end is 30 June of each year. They started in 2020 after seeing growth need for online advertising at the start of the COVID in South Africa. This niche market was created by the growing number of more online selling and buying due to the country going into a lockdown. At the time, the dominant conventional advertising strategies were newspaper, television, and radio. The company does products listing, banners, ads, native ads, and social media. No, I think that one pertains to revenue cycle. There is a part which is on which was on page 3 of 4 that actually deals with what you want you to do. So it starts with Connex grew rapidly in 2021. The public interest score of Connex was 351, and the company was accordingly audited by ANZ in the financial statements 2021. So look at the PIS, it's 351, so it means it's compelled to be audited in terms of the Companies Act. So on 15 May 22, you received a letter from the financial director of Connex. You are a partner at Smangaliso and Andiso Incorporated, a firm of registered auditors. So already you see that you are a firm of registered auditors. So you've got, there is a propensity that you can accept this appointment because you have passed the first test. Are you eligible to actually be an auditor, to audit? Are you allowed? So yes, you are a registered auditor, a firm of registered auditors. Already you are starting to answer the first question, but you haven't seen what is needed anyway. But you know that they need a pre-engagement activity. So the letter requests that your company submits a tender proposal for the appointment as auditor of Connex. Mr. Sebenentul is now a shareholder of Connex. The contents of the letter reads as follows. That's where the trouble starts. This letter is an invitation to make a presentation to the audit committee, of which I'm the chairperson of the service you have to offer. I'm the newly appointed financial director of Connex, and I'll be removing the existing audit firm as soon as I have appointed a firm to replace them. I find the existing firm, like most auditors that I've dealt with in the past, to be inefficient, too expensive, and simply incapable of doing things my way. So you can see that there are issues pertaining to ethical code of conduct. There are ethical issues here. And you will be able to mention them. The attitude management that is basing on auditors, that they're expensive, inflexible, and inefficient, and they don't succumb to his demands, and incapable of doing any things my way. So already they are criticizing your colleagues, and they are not allowed to do so. So that you don't waste my committee's time, I have the following conditions you should consider before you make a presentation. Although our public interest law requires the company to have its financial statements audited, you are not a listed company, and we do not expect you to conduct a comprehensive audit. That precondition not allowed. Management are now putting a condition that will actually make you or render you not able to make your objective opinion on the fair presentation of financial statement. They're telling you that they are not listed, whereas you know that they are obligated to be audited because their PIS is more than 350. All right. The audit committee requires that the annual audit be conducted on the verification of year-end balances only basis. Also, what are they doing? They're prescribing the audit approach on you. I'm not interested in the interim audit, engaging experts, risk assessment, internal audit control evaluation, all other so-called audit procedures which simply increase the audit fee. At the presentation, you must state your fee for the audit. So can you really state your fee for the audit? Because you state your basis of your fees, because your fees will be hourly based, and you'll provide them with your rates. I have explained that we require only a verification of the year-end balances, and have allowed 10 working days for this job. Quote accordingly. If we appoint you, the audit committee will determine your audit fees. If you wish to be considered to have a week to respond to this letter, I have extended the invitation to make a presentation to 7 other audit firms. You will each be given 30 minutes to sell the product. Right? Any comments with regards to this? You are required to use pre-engagement activities to answer this question. Discuss whether your firm should accept the invitation to make a presentation for the audit of Connex Pty based on the contents of the letter sent to you by Mr. Sabelo Ntuli. So this is pre-engagement activities because we're given a hint. Then now we have made mention of a lot of, we have actually answered or responded to some of the misgivings in the letter. But let us look at how we can answer this question. The answer is a big no. You must also assist me if you feel you have some solutions. Please shout. Number one, our firm should not make a presentation for this appointment for the following reasons. The precondition for an audit do not exist, and therefore we would be unable to agree terms of the audit engagement as required by ISA 210. Easy. One of the preconditions of an audit is that management and those charged with governance understand and acknowledge that the auditor must be provided with right of access or unrestricted access to books and records to perform the audit function properly. Sabelo Ntuli made it clear that the information required to perform fundamental audit activities such as risk assessment, internal control, etc., will not be made available to the auditor. So that's the first thing. Preconditions are not met. 2, we will be unable to conduct an independent auditor since Mr. Sabelo wishes to remove the current auditors because they are incapable or unwilling of doing things his way. The auditors must be allowed to conduct the audit as they deem fit. They must use their own professional judgment and adhere to international standards audit. 3, Mr. Sabelo seems intent on controlling the audit, including placing restriction on the scope of the audit. He appears to want to define our audit strategy, no interim audits, no engaging experts, and to force an unacceptable audit strategy and plan on us. We have made mention of that. He requires that we conduct our audit as a verification of year-end balances. This is in no way appropriate strategy or plan for the audit. When an auditor undertakes an audit, it must be conducted in terms of ESA. Risk assessment is fundamental part of the audit as it evaluates and the evaluation of internal control system in terms of ESA must be carried. Sabelo is also allowing the auditors 10 working days to perform the entire audit of a medium-sized entity. Clearly, this will limit the scope of our audit. It is our duty and responsibility to decide upon what is to be done. This in turn will affect the time we spend. Right. Number 4, Mr. Sabelo Ntulu clearly has a lack of understanding of the audit function and the basic requirements of the Companies Act. Besides trying to force an acceptable audit strategy on the auditors, he seems to think that because Connex is not a public company, its audit can be watered down and be superficial. He is therefore not going to accept the fact that we must perform a proper audit. Right, number 5, Connex is likely to have a total ineffective audit committee as it is inappropriately constituted. The financial director should not be on the audit committee. In effect, we'll just be dealing with Mr. Sabelo and will have no recourse to any other parties at Connex should problems arise on the audit, which they will. Number 6, one of the conditions of appointment is that we quote an audit fee based on 10 working days. In terms of the code of conduct, we cannot quote a fixed amount for an audit based on fixed amount for an audit. Our audit fee must be based on such functions as the time spent on the audit, level of experience and competence needed, and the level of IT investment of the audit by the audit team. And Mr. Stabile is clearly not going to accept this. Besides the potential contravention of professional code of conduct, it is also impossible for any audit firm to quote on an audit about which they know nothing, which would be the case in this new appointment. Right, are you still following? Number 7, Mr. Sabelo's attitude will make it impossible to develop a satisfactory professional auditor or financial director relationship. It does not appear to understand that the auditors is appointed by the shareholders to act independently on their behalf. He says, I will appoint, I will remove, I'll do it my way, and we are actually appointed by them. We represent them and we must fulfill their responsibilities, not Mr. Sabelo's. He clearly has a poor opinion of the audit profession. He finds most auditors to be inefficient, too expensive, etc. On the evidence of his letter, his attitude is dictatorial and unprofessional. Don't waste my time. I have allocated 10 days over a week to respond. Okay, next one is that he clearly does not think that an audit will add any benefits to his organization. So he's just trying to comply with the company's act. He's a director of the company, but does not come across as having a great deal of integrity. It's got no integrity at all. Mr. Sabelo clearly does not have the audit client relationship as important and beneficial to both parties. He views the audit opinion as a product and is prepared to give our firm 30 minutes of his time to sell our product. This does not bode well with future relationship. Number 8 is that the further reason not to accept the invitation to tender is that it would not be sound business decision to make to take this client, as it is very unlikely that our firm will not be able to recover its cost. Mr. Sabelo thinks audits are too expensive. If we were to accept the engagement, it is virtually certain that we will end up performing substandard audit work, so don't accept. Number 9, in terms of section 210, IS 10, the terms of audit engagement must be documented in an engagement letter. There is absolutely no chance that Mr. Sabelo will agree to even the most fundamental terms for audit. He will definitely not agree to provide us with access to record documents, etc. That's Sabelo. Do you see how this was answered? Okay, will the solutions for test 1 and 2 uploaded? No, we don't upload them. I'm giving you this because you actually did not do well. I'm just trying to tell you how you should have actually dealt with pre-engagement issues and also professional ethical issues in Mr. Sabelo's letter in your pre-engagement activities. Right. So we've dealt with pre-engagement activities again. Is there any question before we zoom in it? It's a smallest portion that is left. That is your materiality, understanding materiality, and we are done. So do you have any problem? Questions with regards to now understand pre-engagement activities, what the auditors do in the pre-engagement activities. Bearing in mind that pre-engagement activities can actually be done even on the existing clients. Like for instance, it was done by PwC on Gupta associated companies when they had that there were issues with integrity there. They just resigned as auditors immediately. That is client investigation all the time, because an auditor is not obliged to perform an audit on a particular client. It's just a conscious issue on the audit. They can resign anytime, but the appointment should be made by the shareholders. Question? Looks like there is no question. Let's go straight to materiality. I know people do not want to stay in this class. They think it's easy. These things are not easy. And we are doing it just for you, because we feel that you miss some fundamentals in this chapter. So let us look at materiality now. Who can tell me what is materiality? Okay. I want to start where it says what is materiality. So we're looking at the 5th and the last phase of the planning process that the auditors does in determining the level of misstatement that will be acceptable to users of the financial statement. So the figure can only be properly determined once the auditor has fully understood the entity. So the entity is fully understood through 4 P's: your people, paper, premises, and past events. So the auditor should have assessed the inherent and control risk at financial statements level to determine the required level of detection at those particular level. Inherent risk, also known as inbuilt risk, control risk, meaning failure of the system in internal controls implemented by auditor to prevent, detect, and correct material misstatements. So that risk. So materiality is actually a matter of professional judgment. So the auditor will do whatever they do, but at the end of the day, it's his experience and his professional skills that will actually determine the level in which materiality should be fixed at. In terms of this auditing standards, materiality is described and defined as misstatements to be material if individual in aggregate they could reasonably be expected to influence the economic decisions of users taken on the basis of the financial statements. So exactly like your materiality in terms of IS1, where they define materiality as issues that can influence the amount that can, any amount that can influence the decision of the economic decision of the users. Exactly the same. So here they're talking about the users, not the individual. The users are grouped. You look at who are the user groups. Very important. Materiality is actually assumed on the basis of user groups or not on individual or private users or a personal user. Before the definition has appeared, it's important to note that the standard goes on to make two further suggestions that assist in understanding whether a misstatement is judged to be material. Firstly, statements suggest that judgments about materials are made in light of surrounding circumstances are affected by the size or nature of misstatement. Oh, the battery is low here. Try to fix it immediately before things go haywire. I'm trying to fix it. Bear with me. Okay, I've managed to avert that. So the second suggestion is that I've alluded to, that we're looking at the judgment being made by a group of users, not one person. So let us look at the characteristics of materiality. Although the auditor should consider individual misstatement as possibly being material, it is important to recognize that while individual misstatements will not be material, when viewed collectively, several individual non-material misstatements may together become material. So in auditing universe, you will find that there will be some misstatements that are not material, but the auditor will take all those misstatements that are not material or called audit differences and put them under the table called table of under and over, and statement of unders and overs. So materiality needs to be seen in light of users, not an individual. So actually, materiality is not an factual, an automatic and factual decision based on predetermined criteria. It's a judgment which should be made by the auditor depending on the circumstances surrounding the misstatement, the size, the value of the misstatement, and the nature, which is the nature meaning the qualitative issues of the item. So before I've promised that I'll have to look at the group of the user groups, the shareholders, potential investors, debt funders, and other groups. Other groups will be your government, as South African Revenue Services, your landlord if you're entering into a long rental arrangement, suppliers and advancing credits. So the assumptions you can go through on your own. so that you understand that where we want to be, we want to do the calculate, how to calculate materiality, which is very important and which you must know. Okay, before we do that, we make mention of two different terms pertaining to materiality. In fact, three. We've got materiality, we've got performance materiality, and we've got trivial issues. Trivial issues are those issues that the auditor do not consider that they will ever even become material. They are a waste of time if you continue to follow those misstatements, because they will never be material, even if aggregated or so. Performance materiality enables the auditor not to reach materiality when during the audit. So its materiality figure maybe at 75%, then that is performance materiality. And we've alluded that materiality refers to the level of acceptable misstatements for financial statements as a whole, as typically determined when establishing the overall audit strategies. Right. Those three terms I've actually dealt with, and we must be able to go back and look at them ourselves or ask some questions. So how to calculate? There are steps necessary to calculate materiality. So you should understand those steps, because there can be a question on how to calculate materiality. And when we deal with this, we also deal with the basis for calculation, which was your question. Unfortunately, we won't be going through your question, but I'm telling you, I'll be providing you with actually the ideal solution for that, but definitely not the question, because we hope you've forgotten the question now. Let us look at materiality and the calculation of materiality. In fact, it's a three-step issue. You have to choose a set of financial statements, choose a base component in the set of figures. Number three, determine the range for base. And then you come to materiality. You calculate your planning materiality figure within the range. The range will deal with the range as well. So from there, you have to pick up what you call performance materiality, and also come up with trivial issues, clearly trivial issues. But we won't be calculating trivial issues, which would be maybe 1% of materiality, right? So first, you must know that materiality is actually a matter of professional judgment, and we've got two types of materiality. We've got two categories. We've got the quantitative materiality, which is based on certain amounts, and we've got qualitative materiality, which is based on the nature of an issue. If it's a disclosure issue, in this particular case, if you don't disclose your related party transaction, for instance, it's qualitative, because if you disclose them, the user groups will actually be able to be influenced in a particular way in taking their economic decisions. So the non-disclosure or disclosing certain items in a different way, irrespective of their amounts, can actually be material. So you should have to choose a set of financial statements. So when you choose a set of financial statements, you'll be given prior financial statements, which are audited and which are a good source of your material, because they've been audited. They are free of material misstatements. You've got current financial, unaudited financial statements, which you can also choose from. And you've got two other items. You've got your budget figures, which you can use depending on how accurate their budget. Not accurate. Accurate is not a good term because budgets are actually not accurate at all. So that's why they're called budgets. Reasonability of the budgets and also your forecast. You can use all those prior year financial statements, audited, unaudited current financial year statements, your budget amounts, your forecast. Forecast is actually making your budget reasonable. So you can actually use that as well. So you have those. So in the question, you had all of those except your forecast. So if you use one, you need to be able to explain why you're using that. Document it. Audit is about documentation. Document that I used the prior year financial statements because of A, B, C, and D. I use the current because of this. Okay, the question now is how can we identify which components to use? For example, revenue or total assets when calculating materiality. So we're still coming to that, Tando. We will actually deal with that because it's the next step that we need to look at. Now we're just picking which financial statements should we use or financial information that is available to us to use. You can use any because materiality is actually a matter of professional judgment, but you'll have understood your client anyway. In fact, even in your case study, will be given information that there is a tendency from management to overshoot budget or under budget. So if you use your budget, it won't be, they won't give you the true picture of what is happening in the company, and materiality that is based on false information or incorrect information will not assist the auditor. So rather, if you are given audited financial statements, rather use audited financial statements in that particular scenario. And you must support yourself to say, I'm using audited financial statements because there is a historical data to the fact that management are not all fair with the budgeting processes. In most cases, there are variances that are not explained, such that budget is always reduced to a level that is reasonable. So that will be your case study with those particular issues for you to pick up. Right? Let us look at components. So the components that are there to be used, you have your revenue, you have your gross profit, which is always fluctuating. So if you are using gross profit, you must also take into cognizance of issue of abnormal items that are contaminating your gross profit, also your revenue, and take them out, their effect out of revenue. If they are in gross profit, if they were reducing your revenue, increase your revenue. If they were reducing your profit, add them back to your profit because you don't want them to have an effect on your profits. So you have a question with an abnormal item, and you have to be aware that you need to reduce your base with that abnormal item. Same with operating profit before tax. If there is an abnormal expense, do the same. And also the other basis is your assets, and the others is your equity. For instance, most people invest in businesses to get profit. So, but now in most cases, profit is always fluctuating. Your gross profit is always fluctuating. Hence, we are unable to use an unstable base for our determination of planning materiality purposes. And in most cases, revenue is favored in that particular case because your revenue should either increase or remain stagnant. Otherwise, if it's decreasing, then there's an issue of going concern. So revenue, in most cases, should be used. In some cases, assets are used to actually come up with as a base for determining or calculating revenue. Not revenue, calculating materiality. So the question now can be answered that in case of a civil service company, the investment there is too much on assets. There is a bigger asset base. So it's better to use assets as a base for calculation of planning materials than any other things, because the business is service oriented and it's investing a lot in assets, and assets is everything for that particular business. Assets will actually be the correct benchmark. Manufacturing company as well, they invest extensively on assets, so they've got an extensive asset base and use asset base in that particular case as a benchmark for materiality. So when the firm is actually, or the capital structure is more debt financed, so the base there, which is recommended, is interest. Use interest as a base because it will have a lot of interest item. But the cardinal rule is that use a stable base. The base should always be stable. Right? So this is not prescribed anywhere, but audit firms has actually, to determine the ranges there, actually came up with the ranges so that they'll be able to calculate materiality. So if you are using revenue, they said 0.5 is to 1. So the lower range is 1, it's half, and the higher range is 1 for revenue. When using gross profit, lower range of materiality is 1 and 2% is the upper range. Operating profits, it's 5% and 10%. When using gross asset base, 1% and 2%, same as gross profit base. If using equity as a base, 2% to 5% of the equity is used. 2% being lower range and 5% being upper base. So here they make mention, they make an example of 100 million revenue, 1% of which will be, they calculated 1%. 1% of 100 million will be 500,000, and the upper level is 1%, which is 1 million. So right now, the next step is to calculate materiality figure within the range. So we've done that, we've made an example there. We've done that, then the next step is for you to calculate performance materiality, which is only 75% of the materiality, to be 75% of the ranges between all the ranges. So the ranges, either you take the lower range or upper range, depends on the issues within the company. If there are no issues and the user groups are not sensitive to misstatements, you can stay at 1 million. If there are issues, you can be at the mid-range, or if there are not sensitive at all and everything is working fine and you don't suspect anything, you can actually be at a higher range, for instance. So here it means there are no risk. Lower range means there are a lot of risky issues. Then now you need to have that precision of another 5. All transactions above 500,000 being subjected to an audit. That is materiality. Then that's not all. You go and also calculate what we call performance materiality to be able to start performing the audit. And when you're performing, when you are calculating and using performance materiality, you want to ensure that material misstatements do not exceed materiality figure. Then the last one will be your trivial, clearly trivial issues if you want to be dealing with now. So this diagram here explained bottom end of the range, mid of the range, and top end of the range. So if this was operating, it was revenue, it was half of the revenue. Total and upper range will be 1% of the revenue, and mid range will be 3/4 of revenue, and so on and so forth. So if there is increased user sensitivity to misstatement, go to the lower range, which is 500,000. If there is a decrease, then you go to 1 million. That is high risk of material misstatement, and there is a planned response to increase the overall extent of testing across the audit as a whole. So the extent of audit actually follows the materiality. So this will be increased sampling, increased items be subjected to audit. And when you've got 1 million, then fewer items will be subjected to the audit because you are responding to the decreased sensitivity and lower risk. Otherwise, we'll over audit. So the final setting of materiality will actually be a matter of professional judgment. No one will say, okay, materiality should always be set at 150, you always increase at 500. You always increase it based on what you find out and based on your experience as an auditor. I think at that point we should be ending. And do we understand what materiality is and how to calculate materiality? I'd invite you to go back to your books, tutorials, and look at how materiality was calculated and the basis. And your test, your assessment dealt with materiality here. It was not a calculation. Let me check what it was without divulging too much information. But the question that was here was a very good question, and students didn't do well on this question as well. That's why we are here. I expected a lot of interaction with regards to materiality. So the question was, we were required to assist as to which set of financial statements and which components within the financial statements would you use for determining the materiality of the company for a particular period of time. So you were given audited, budget, and unaudited. I said prior year, which is audited, current year, unaudited, and budgets. So within the case study, we were also told that the company always meets its budget. So now you've got 3 sets of financial statements to consider. All right. The audited one had 200 million. The unaudited one has 201, and the budgets, because the managers always meet their budget, there is an increase of 220. Because there is an increase in revenue of 220, and there's the trend that the revenue was always increasing, so the budgets are always met, then you wouldn't falter you if you say we're using budgets, because budgets are actually will be met. Management are sure that budget will be met, and there's been a trend in the increase in revenue year to year, right? So things like that you must consider. And the base year was supposed to be revenue, and revenue as a base, we're given the percentages that we are supposed to be using as the ranges that we're supposed to be using. But definitely we're not allowed to calculate materiality. You were supposed to tell us about financial statements to be used and the components within the financial statements you would use to determine materiality. You can actually use all the elements and explain why you're using them and still get marks. The question was limited to 5 marks anyway. But please follow the steps that we've been discussing now, then you won't falter anyone with regards to that. And don't forget that as much as materiality is a matter of professional judgment, in case study situations, you are given certain clues so that you'll be able to support your responses. Use those responses, not say, you can say that materiality is a matter of professional judgment, but we've seen the following, which actually favors the use of revenue as a base. 1, 2, 3. We've seen the following favoring the use of budget information as a base to calculate planning materiality, and so on and so forth. So as long as you support your answer, you get some mark. You can see how difficult it is to actually pass these assessments, because they are looking for application more than a theory. But you can, in your answer, you can use your theory to actually respond to questions and get some marks. Any question before we close regarding the items that we have actually discussed? Yes, so we will post this class online, definitely. Can you please for 5 minutes repeat materiality? Okay, for 5 minutes, materiality is the amount set by an auditor so that they are able to perform their audits. So the definition in accordance with the standard is there for you to see. Let me go straight to the standard. The standard, which is 320, you must also look at 320. 320 defines planning materiality and performance and performing an audit, defines misstatements to be material if individual or in aggregate, that is together with other misstatements, they could reasonably be expected to influence the economic decisions of users taken on the basis of the financial statements. So any misstatement that can influence the group or the users of the financial statements is taken as material, okay? Individually or in aggregate. I even spoke about a schedule of overs and unders. If you have a misstatement that is under or over, you just include it in the statement until at evaluation stage and see if there are material. If there are material, you ask management to actually resolve those issues. If they don't, then you modify your opinion accordingly. So that is materiality. And materiality is categorized into 2. There is quantitative materiality, which is based on the amounts, and that's what the one that we've just calculated. And there is qualitative materiality, that is to do with any contravention of your disclosure requirements in accordance with EFFYC, or sometimes non-compliance with laws and regulations can be material, but in terms of their size, they are not, or the amount, they are not. we've made mention of failure to disclose related party transaction. It's material to the users because some people will actually take this economic decision based on whether or not the owners are actually in transaction with one another, which also will not be at arm's length. So that's why that disclosure is always required. So that is qualitative materiality. And there are 4 steps necessary to calculate this materiality. And we said it's very important that you understand those particular steps. We've just gone through them. First one is choosing set of financial statements. Got 4 sets. You've got your audited, unaudited, current year, budgets, and forecast. So you need to choose. The scenario will give you 4 of them and choose the correct one based on the scenario presented today in your case study. The second step is choose the base or component in the financial statements to set the figure selected. So you've got your revenue, gross profit, operating profit, assets, and equity to choose from. And based on the information supplied on your case study, we'll be able to pick up which is the relevant component to pick in the calculation of materiality. And that is your page 531. You must read through and see they are telling us that for a manufacturing company, because they're investing too much on assets, you can justify the use of in calculating materiality because they've got extensive investment in assets. Number 3, determine the range. The ranges, I said, they are not prescribed, but they've been set by auditors. For revenue, there is 0.5 to 1. For profits, 5 to 10, 2 to 5, and so on and so forth. We discussed that. And then after that, you calculate the ranges, and based on the risk involved, you take whether upper level, midpoint, or lower level, depending on the issues, right? Right, I think I've answered you, and it was for 5 minutes. It took 5 minutes. So if the entity is relying on debt, the structure is on debt, you can use interest as a base. It's very important to do that because the lenders will be interested in looking at interest. Right, that was from Tando Gosle. Shows. Right. All right. She wanted to repeat to repeat the solution in 5 points. Okay, I'll do that for you. But now I'm scared to do that, giving you a solution for this one because we still have to look if we can come up with another question similar to what we actually tested in you. But I can tell you what we did. We tested in you on step number 1, choose a set of financial statement figures. So it's either it's prior year, current year, prior year is audited, current year, and you'll be given budget information. And in your case study, you'll be given a scenario, maybe to take out budgets, they will say budgets are not met by management, so they're not taking budgets. Now you're left with audited financial statements and unaudited financial statements. You decide between the two. Now we've eliminated the other one. So if they're telling you that unaudited financial statements are full of material misstatements as per last year, so you have one alternative left, which will be audited financial statements, and you have to use audited financial statements. Then you use to choose number 2, you'll be choosing the base component in the set of the figures. So selected, you've selected audited financial statements, and you can take either revenue, profit, operating profit before tax, asset, and equity. In case of, we made an example of a manufacturing company investing too much on or extensively on assets. So it's better to take that base as your to calculate materiality. So assets would be the correct base for a manufacturing company, and also a service company invests extensively on assets. Assets is good for that, and the others you can use revenue. And gross profit and operating profit before tax are not good because they are not stable components to choose. So in most cases, they will guide you to say gross profit and operating profits are actually stable. Over the years, auditors have been saying that. Then if they give you that particular scenario, they are driving you to say you can use that, but you can also take revenue, because revenue is the one component that has been used to compensate for the unstable nature of both gross profit and operating profit before tax, right? And also gross profit and operating profit before tax, there are abnormal items who should take the effect of those out of gross profit and operating profit before you calculate your materiality. So you will also be guided there. They'll tell you that there's an abnormal profit of so much, or there's an abnormal expense that was made, that was recognized of so much. So if there's an expense that was recognized in the current year, take it out, or in the previous, take that expense out by adding it back on your operating profit. Same with gross profit. If something happened with stock which is abnormal, add or subtract it on your gross profit to arrive at the gross profit ready to be used to calculate materiality. Right. Happy. I think I've covered you. The ranges, you just determine the ranges, you are given the ranges. In exams or assessment scenarios, we will always be given the percentage there for the ranges. Yours is to calculate. And also, you'll be asked to calculate performance materiality. Performance materiality will only be 70% of the calculated, 75% of the calculated materiality. And that's all that you need to look at pertaining to the calculation of materiality. And understand what materiality is used for. Should be used to control your audit, the extent of your samples and the extent of your audit. How far are you supposed to be going? Are you prepared to go to ensure that you eliminate all material misstatements? Right. I think I've covered everything. The upper level of materiality means, in case of revenue, half is lower level, 1 is upper level. For gross profit, 1% of gross profit is bottom end of range or lower level, and top level or high level is 2% of gross profit. For operating profit, 5% of operating profit is bottom end or lower level of range, and top level is 10% of operating profit. Excuse me, of operating profit. And also, gross assets is 1% of gross assets, and the top end or upper level is 2% of gross profit. But in terms of determining which level to use, because there is also a midpoint, you need to be looking at the scenarios provided by the case study. You will be able to pick up that the audit is risky. If it's risky, then you need to go, you need to tend towards the bottom end or the lower level or the lower range, which is, in case of revenue, half of revenue total. Right? Right. I think we all understand now. In case you don't understand, you can always set up a meeting with me. We will sit down and discuss this particular issue so that you end up understanding. Materiality is straightforward. The only difference will be you understanding the scenario and trying to dissect it in such that it fits your theory and it fits your steps that you take to calculate planning materiality. And also understanding what is materiality. You must understand the theory behind materiality. As students, since there are no other questions, I have to thank you very much for attending the course, and we'll see you next year. I am sure you're going to make it through, because I won't be able to see you going forward until next year. Thank you very much, and bye.